How this client who's just turned 40 is going to retire on over $100,000 per year by investing for the next 15 years. So this scenario is for a young family who've just turned 40 years old, they're rent vestors, and they have a combined income of $200,000 per year. As we can see up the top here, they have a desired retirement age of 55, which for today's standards is an early retirement, and their desired passive income is $100,000 per year just from property, which is almost 3 times more than the average Australian retires on in 2024. Now let me run you through a few key bits of information. Like I said, combined income of circa 200,000, rent vesting in Sydney, paying about $900 a week in rent, and they're starting with about $300,000 worth of cash of which they've saved. Now for this scenario, we're purchasing 2 properties in their personal name and 1 property inside of a self-managed super fund over a 2-year period. Now we've projected out 3 purchases for this client. The first one at $750,000, the second one at an $800,000 purchase price, and the third one inside a super at a $700,000 purchase price. The first 2 purchases will be dual occupancies with a rental yield of 6% and a long-term compounding growth rate of 7%. And the property inside a super will just be a standard set and forget asset with a 4% rental yield and also a 7% compounding growth rate. And 7% sits slightly above the Australian average. So these numbers, I believe, are conservative. Now let's get into the scenario. So as you can see here, purchase price of $750 in 2024, equity of $112,000, which works out to be a 15% deposit we put down, debt of $637, and still savings left over of $255,000. Now those savings are calculated based on this whole year's worth of savings, plus what they have left over from the deposit. Now we go to 2025. The first property we've purchased has obviously had some growth. We've saved a little bit more money because this property is going to be self-servicing, so having no impact on our ability to save. And we've now purchased the second property at $800,000, which puts our portfolio market value at 1.6 mil. Equity position at 160, which means we're 90% leveraged, and $200,000 in savings, which means our actual position is $1.2 million because we've got $1.4 million worth of debt minus our $200,000 sitting in offset. So our real loan to value ratio is sitting below 80%. Now, as we can see here with our borrowing capacity calculator, which works out borrowing capacity at a 6-to-1 debt to income ratio, you can see our borrowing capacity is about $1.7 million. This is calculated at a 6% interest rate. We're going to have $1.4 million in debt, which means we've got about $300,000 left of borrowing capacity. So we're almost at our limit with personal borrowing. And that's what helps guide the decision to now start investing inside of our self-managed super fund, because we need to increase our borrowing capacity, decrease our debt to be able to buy more property in our personal name, which as you can see here, if we look forward into 2029, we then start to have a borrowing capacity of around about 600 grand. So we probably have 4 years between when we buy our second property and our third property in our personal name. This is obviously not factoring in things like if rates come down, our borrowing capacity naturally increases, or if we get a significant pay increase, etc., etc. This is working out the best we can with the information we have. So we now go to 2026 and we've got the market value in our personal names of 1.7 million bucks, which is the 2 properties that we've purchased. Equity of 300 grand, so those properties are growing nicely. And we've now purchased a property in the self-managed super fund for 700,000. We've put down a 20% deposit of 140 grand, and we've got debt in there of 560 and still $50,000 of cash sitting in there, which is liquidity we need in the fund. So total portfolio value, including personal and our self-managed super fund, is just over 2.3 million bucks. Now, if we do not buy another property from 2026 to our desired retirement age of 55, which will be 2039, this is the outcome. Voila. The market value of the personal properties will be 4.1 million bucks. Our equity position will be at $3.1 million. Our total debt, you can see there, is at 970 grand, and we've got $950,000 in our offset account, which means we've essentially got no debt. We've got 4 million bucks there of net asset value. The reason we've got still $1 million worth of debt and $1 million essentially in offset is because we've been putting all of our surplus cash in our offset account to continue to offset our debt naturally. And the same thing inside of our super fund. We've got a market value of just over 1.65 mil. We've got equity of 1.25 million, $430,000 worth of debt, and $130,000 in cash sitting in the fund. So essentially we've got 300,000 worth of debt and we've got almost 1.4 million bucks worth of net equity. So combined between our net asset value inside of super and our net asset value outside of super, we've got about 5.5 million bucks worth of net assets. which means if we sold everything down, paid the selling fees, paid a little bit of capital gains tax, let's say we invested $5 million into a managed fund, which would be giving us 5% per year in returns and not eating down into our capital base, we'd be getting $200,000 a year in gross income, which obviously in 2039 is not the same as $200,000 in 2024 because there's this thing called inflation. And if it was invested correctly, potentially inside of a self-managed super fund, and we were in pension or part pension phase, the income may be tax-free. Make sure you get financial advice on that because I'm not a financial advisor. But you get the point. You invest aggressively for a few years, you do have a high loan to value ratio, you hold the properties for another 10 or so years, and voila. And this is a very conservative approach in my eyes. Because in reality, if you look at the serviceability chart here, we really could invest much more aggressively if we wanted to make that number significantly greater at the other end. But it shows $200,000 of combined income, rent vesting, you buy 2 properties into personal name, one in the self-managed super fund over a 3-year period, hold them for 10 to 12 years, have 7% compound growth, which is what Australia has done for the last 100 odd years, and you retire comfortably. I'm here all week, folks.